But while as you look up what's wrapped up in the first quarter here, any thoughts about that? Any exciting things? Anything you're worried about, or kind of just give us your opinion of what you thought happened in the first quarter here?
Yeah, happy to do so, Joe. And again, thank you for having me on the podcast and able to engage with your clients. Technology is an amazing thing. Happy to jump into that, but before I do, you'll have to forgive me. Mooney Talks, I love that. That's that is fantastic. That's awesome. So getting back to the first quarter, indeed, we had a bit of an extension. If we talk just about the equity markets of that massive rally that we saw from the October lows of last year. And really, at the center of everything has been interest rates. Now, more recently, there's been a bit of a divergence in that year to date, as you know. Interest rates have gone higher, but the equity markets have continued to do well, say for the last week or so. They've pulled back a bit from some of that big surge. The S&P was up north of 10% in the first quarter, so there was an extension of that. And a lot of it from the equity markets, it was driven by better than expected economic data. If it was employment reports showing that the employment market's still healthy, consumers still in good shape because of the low unemployment, and economic numbers have been coming in better than expected. So that has been good for stock investors. On the bond markets, it's been a bit more mixed. If you're talking about areas such as high yield, which have given you that higher coupon cushion, they held in okay, but they lagged equities. But if you look at the treasury markets as a proxy, the 10-year treasury yield, it was below 4% when we came into this year. When I was looking earlier, it's at about 4.6 today. So the bond markets have a little more of a challenging go. And it's really the corollary that would drove the equity markets higher. Economic growth being stronger than expected, that's good. But there's been this combination of good news is good news or good news is bad news for the bond market because people were expecting coming into this year that the Fed may cut rates 6 or 7 times. Now people are thinking maybe one or two, and it's going to be pushed later in the year because of that stronger economic growth that I referenced.
That's awesome. So as we look out, or as actually AllianceBernstein and yourself looks out to the remainder of 2024, is there anything
Mhm.
that obviously you already touched on the interest rate and the cuts of the Fed and things of that nature, but is there anything you're kind of looking out for or you're worried about? Or I know the big one's always the election, which, we've been
Mhm.
doing this a long time. I'm not that, they come and they go type scenario,
Oh yeah.
but that's the number one question that we get asked, I would say, from clients. And I know we downplayed in the industry in regards to
Mhm.
that, but is there anything you're really concerned about or that you guys are looking out for the remainder of the 2024 year?
Right. So I would say a couple things. That one of the things that we have a degree of, I wouldn't say certainty by any means, but where we have more educated knowledge on would be where rates are going. But that's been very, very tricky. I tell people write some of these economic forecasts and Fed rate cut forecasts in pencil because it's again the economy has been more resilient than people expect. So I would say from a fundamental perspective, Joe, the things that I would say we need to be mindful of are higher rates, even from here.
Okay.
Because for equity investors, the higher interest rates go, that's competition for stocks. And people might start to say, well, you would go back to 2022 when the Fed was hiking rates so aggressively. I'm not saying that that's going to be happening this year. We think that they're done. We just think they're going to be on extended pause mode for a while.
Yeah.
That's something we have to be mindful of. But at the same time, I remind investors that if interest rates are going to be high, if you're looking for real returns, especially after inflation, equities are a good spot to be. Say for inflation spiking, which again we don't believe that that's going to happen. We've seen some degrees of improvement there, but I would say the rates thing is likely to cause a degree of volatility that we need to be mindful of. The other thing, which we certainly cannot handicap at all, are geopolitical risks. That's something from our radar perspective. Look, the world has become a bit more of a dangerous place, and we have no insight in terms of how things are going to develop there. But that's something that if we had, say, in the Middle East tensions got to the place where clear oil channels would be blocked, that could be problematic. So if you saw oil prices spike, bonds and stocks would the capital markets would go through a tough period of time there for sure. But again, that's hard to handicap. all the more reason why when we talk about, so many times people will talk about the Magnificent Seven. If you go back to what they were talking about on a certain television station, right? Well, then it became the Magnificent Four or the Fantastic Four. It's like, okay, look at Bloomberg and pick your choice, right? Who is where they are now. My point is let's talk about the magnificent others. Let's look for some of those areas in the equity and bond markets that maybe have not been recognized and are trading at attractive prices. That gives you a degree of margin of safety, even if markets get rough and tumble. But in terms of, to your question, what we're concerned about, I'd say it's rates and geopolitical risks. But we have to do what we do, and it's look for opportunities that we think are attractively priced, and we're finding them that now.
Awesome. So another big topic that we're hearing actually this year, it was kind of funny because if you look back, like I don't know, I'm dating myself and the years kind of blend together. But a couple years back, it was all cryptocurrency, blockchain technology, blah, blah, blah. So now the new big buzz term that I think a lot of clients are seeing, and you're starting to see it in the media and the headlines and pop all over, is AI, artificial intelligence. It's going to dominate everything. What's AllianceBernstein's thoughts and your thoughts in regards to the beauty of AI and the scary parts of AI, or how are you guys leveraging AI in regards to do business better?
Right. So internally at AllianceBernstein, we've leveraged it. We've taken advantage of it over the past few years, before the whole AI halo, if you will, really took hold last year. If it's areas of data science that drive research efficiencies, that allow our research analysts and portfolio managers access to information more quickly, that reduces more labor-intensive tasks, so they could be on the, let's say, higher on the food chain in terms of engaging with company managements, as an example, as opposed to mundane, as I said, laborious type tasks. And we've been doing that, I would say, over the last 3 to 4 years, in fact. So internally as an organization, that's how we've been leveraging it. From the standpoint of an investment opportunities, if I could speak to that, Joe, unlike, let's call it the tech bubble, where you had some of these companies trading at price to infinity, who really didn't have real business models, artificial intelligence is certainly a real thing. But the opportunities there extend beyond just one semiconductor stock. There are other semiconductor and semiconductor capital equipment companies, the people who actually make the semiconductors, the machinery that makes the chips. There are software companies there. There are investment technology consulting companies. If you're going to build a data center or you're going to leverage your cloud computing network, well, you need people, effectively architects, who can consult and tell you how to best build these things. So it extends beyond just one semiconductor company within the technology complex. I talked a little earlier about the magnificent others, right? If you look at some other areas, such as healthcare, who would think that healthcare, everybody is so focused on the technology sector, but there's a lot of these unrecognized opportunities that we're very excited about. I'll give you a couple of examples. There's a surgical device company, a robotic surgical device company that we've owned for quite some time, to where, thanks to artificial intelligence, the computing power of some of the surgical tools that they use is 10,000 times greater than the past generation of tools that they had before. Let's think about that. What does that mean? If you're a surgeon and you're performing a surgery and you're using one of these techniques, and one of the instruments, and one of the instruments is flashing a red light saying, don't go there. That could be a problematic area because of all past surgeries. There's tens of thousands of surgeons who've done all these procedures that are building on top of that information that can drive that robotic device to say, oh, we can't go there. If it's, say, sinus surgery or you name it. What does that lead to? That leads to better outcomes for the patient, right? So that's something that's not being recognized. And then it goes beyond human areas on healthcare area. If it's clinical and diagnostics companies, they could get a diagnosis, let's call it time to diagnosis, because of some diagnostic tool that a veterinarian can use, that could save a veterinarian 20 minutes on a veterinarian visit. Think about that. That's money in their pocket, right? To where that visit time gets cut shorter. The accuracy of that diagnosis is very solid because of all those learned experiences, and they could see other patients, if you will, if it's a dog or a cat in the companion animal space. And lastly, there's companies that digitize clinical trial data. Here's an interesting stat. All right. So 8% of people who go for quote phase 1 clinical trials for a drug application, the people who do that to final FDA approval, the percentage of that is only 8%. That's it. So 92% of the time, people aren't going to go from phase 1 clinical trials to approval. So if you could digitize a lot of these drug discovery and these drug discovery trials, think about what that means to pharmaceutical companies. If I'm the CFO of a pharmaceutical or biotech company, I want access to that. That really improves that efficiency. That could say, no, let's cull some of these projects that don't make sense, but could get you that information faster. So it extends, as I mentioned, beyond the technology space. And those are just a few examples within one sector. I could keep going, but I know we want to keep this short.
Yeah, so I'm actually, I agree with you. I'm super excited too. We were in a meeting the other day and I actually pulled out a book to flip through and the dating myself now. The younger people were just going to the internet and looking it up. But I still remember
I still read them too.
I still remember going to the library to get data or and then when the internet came out, how everybody thought that was going to, be a big disruptor in regards to stuff. And just the amount of advancements that we've made in my short lifetime, I'm excited to see how the AI kind of continues to drive those things forward. So I agree with you 100% in that area. As we kind of, to keep it, like I said, keep it short, we try to keep these under 20 minutes if we can. So as we look out into 2024 or 2025, I know you talked about rates a little bit and then possibly pausing for longer, which we're in the same camp. We agree with you there. So what are you looking out for, or what excites you? I like that on a positive note. What's something that kind of excites you for 2024 or coming in 2025, or things of that nature that you're kind of like, yeah, this is we're in a pretty good position here. We're kind of excited about this. We're optimistic about this area.
Sure. So the fact that the economy is still on good footing as an equity investor in particular, or let's call it even in fixed income, if it's tax-free bonds in terms of municipal bonds, or if it's in the credit markets, be it high yield or other investment grade bonds, that we find opportunities there. It's not a bad thing that the economy is in good shape. I know the bond markets get disappointed. They're like, gosh, we were really hoping the Fed was going to cut really soon. Okay, we're okay with that as long as the economy is strong. That doesn't scare us. So that makes us happy. And so I would say that's one component, because that's good for anything in terms of stock and bond markets ultimately. The other thing I think that's encouraging that is, and again, I know a couple months do not make a trend, but we've seen the degree of the market, let's call it green shoots as we like to, in the stock market, because as you know, Joe, it's been such a concentrated market. If you look at some of the big popular indices, it's been driven by just a handful of stocks and the 10 biggest names. But we looked at this from early February through, let's call it the end of first quarter, we started seeing small caps, we started seeing value stocks actually outperform large cap indices such as the Standard & Poor's 500 index. That degree of broadening, again, some of these magnificent others, if you will, are starting to get some recognition because they've been left behind in such a strong market rally that we saw last year in 2023. And as we talked about, extended into this quarter. That's something that gets me a bit excited because I always like to say, it's not so much a stock market, it's a market of stocks. And people are going to start to recognize that, hey, some of these stocks they have left behind. And oh my goodness, you're telling me there's more than just 7 companies that are going to have consistent earnings growth that can lead to higher stock prices over time? I don't think so. And the market is starting to recognize that. So I think that gets us excited. And the other thing, I'm an equity person by trade. That's how I grew up in this business, but I did minor in fixed income. You can see that by some of the gray hair here. We see areas such as the high yield market, or areas within the tax-free bond market where the income is back in the fixed income. I know bond prices go down, but now you're looking at some of these bonds that are being priced at 93, 94 cents on the dollar. As they mature, you get this pull to par. And oh, by the way, you're getting paid while you wait. So there's exciting opportunities in the fixed income markets as well. So again, with some of the other caveats, so you always have to acknowledge the risks. You can't turn a blind eye to those. But at the same time, we know that if one looks at, say, the equity markets or the credit markets, and what you and your team do at Vinny Lyons is you're building a well thought out investment strategy for your clients. And their goals that they're looking for extend beyond the next quarter. Right. So it's just keeping that in mind, and it's the time in the market, not timing the market, which is ever so critical. And again, we're finding a number of opportunities. We always do.
Oh, that's awesome. I'm excited too that I think out of the 15 or 20 minutes that we here today, you only mentioned one data point that I think was in headline news, which we talk about this all the time, that a lot of stuff that's just bombarded out there on multiple channels and media channels are not what a lot of professionals are really looking at. It's just kind of noise that's scaring people, in our opinion, and distracting them to kind of the bigger pictures, which is why we love having yourself come out here, Walt, and seeing, because you're a steward of these people's money. Regards to, here's the things that we're worried about, here's the things we're excited about, here's things that we're actually doing. So again, I want to thank you for sharing your time. And then just kind of end it there. And everybody, if you want to like us or follow us on Facebook and LinkedIn. And Walt, I think you guys have a capital markets outlook that's on your website that people can go to. It's
That's correct.
lionsbernstein.com. You can just Google it. So I'll try to put it in the notes at the bottom here, the little, yeah, you can tell I'm dating myself. Whatever they put on the bottom of the YouTube video, we'll put it in there. So, right.
Well, we appreciate that, Joe, and many thanks again for having me on and allowing us to be a partner with you and your clients. We do not take that for granted. So thank you so much.
We appreciate it. Well, thanks so much.
My pleasure.